Here, we've shifted things around a bit, as you noticed from some of the previous weeks, but we like to talk about, global crude on the oil on the water, because this is something that I think gets left behind when we're looking at how much crude is actually available. And then at the end of this segment, we break it down by regions just to understand, how tight is the market, where are some of the drivers in terms of flows. So global crude on the oil on the water is below where we were in 2020, but still above where we were in 2021. And still remains elevated. And a lot of that is being driven based on what is happening on crude oil and storage. And we continue to see this elevated amount of crude oil that's stuck on the water. And it's a mixture of things. It's timing delays in terms of movements. But COVID, one of the things that we've been talking about is the supply chain issues, how there's all these problems. And crude is no different. You still have to get to a port to offload it. You need people to do that. You need space to do that. And a lot of these areas are competing with cargoes or competing with other ships. So it's just there's delays everywhere. So to look at just land storage, you're missing a big piece of the story just because the issues that are creating shortages in a store near you is also creating a shortage in the amount of available space to offload some of this oil. So here, when you look at crude oil on the water, still remaining elevated, the biggest driver of the drop is crude oil in transit. So it's now back to the 5-year average. We do expect to see this start going back up, but again, just not setting that new seasonally adjusted high, but just staying above the 5-year average, but again, kind of well within that top of the cloud. And it's just because you have a little bit of a slowdown at this point of purchasing. And then as we get out of maintenance season in Asia, we'll start to see that pick back up. We're already starting to see some of those adjustments that will accelerate. And we're going to see but the question is going to be, when does the U.S. quote unquote wake up and start increasing its imports? Now, the issue that the U.S. faces is we've sanctioned Venezuela, we've sanctioned Iran. We may sanction Russia. So then you look at the Mayan, the Mexican terminal decline. Where are we going to source our heavy barrels? We've officially now killed the Keystone Pipeline, so none of that is going to come down into the Gulf of Mexico. So you're getting a lot of these problems when you're looking at where are we going to source these heavier barrels as we go through, not just this year, but this is, and beyond. And this is where we talk about, the issues on crude quality. Now, when you look at crude oil floating storage, we're new seasonally adjusted high. We're above where we were in 2021. That is going to continue to be the case just as some of these additional cargoes show up. Some cargoes continue to struggle to sell, and that's going to keep things well above normal. And then even as they show up at their doorstep, which is as we've seen in Asia, they struggle to go from the offshore onshore, which again is creating that skew between what is on the water and what is on land. Now, speaking to some of the halfway points, India's daily sales of gasoline and diesel rose about 7% each during the first half of February from last month as traffic movement picked up. Again, Omicron is moving past us. The bigger issue on their economic prowess continues to be diesel. Diesel sales by India's 3 biggest fuel retailers were 2.65 million tons, 6.7% higher than January, but sales were 7% down year over year and 14.7% below February of 2020 before the pandemic impacted India. So again, you're still well off of normal, better month over month, but still struggling against what is normal, which is why, again, that economic growth is going to be a struggle. And obviously, as diesel prices go up, that's going to only put more pressure on inflation as India's inflation is now back above 6%. Gasoline, on the other hand, sales increased 7.3% month over month, which was 0.1% better than year over year, but still 2.1% below February of 2020. So getting better, but again, a little bit of a struggle. But on an economic level, it's a bit more concerning when you look at the diesel front. Now, when we turn to the U.S., gasoline had a small increase of 133,000 barrels a day, still well below the 5-year average. Distillate had a drop of 182,000 barrels a day. All of this very much kind of in line with what our thinking was. Propane had a big increase of 603,000 barrels a day after that big drop. Again, it's just more of a timing delay, but we should stay right around the 5-year average as prices continue to be elevated. Crude exports, as we were saying, crude was going to have a big drop. This is even a little bit bigger than what we were expecting, but we also had something bigger last week than what we were expecting. So yeah, I guess it works on both sides. So if you average out what we were saying for last week and this week, we're right on the money. But you had a drop of 829,000 barrels a day. And that's something that is going to remain under pressure, just given where pricing is in the market. It'll be a bit better from here, but again, still remaining a bit capped. Now, when you look at gasoline exports, we're still seasonally adjusted all-time low. We expect this to come a little bit further into the bottom of the cloud, especially as some of that demand wakes up into Africa. But again, that's just going to keep us well off of what is normal. Now, diesel distillate is going to stay well below normal, again, either right at the bottom of the cloud or new seasonally adjusted low, as the demand and pricing still remains robust. It makes all the sense in the world to sell it here versus selling it abroad. Then when you look at ethane, again, same thing, waffles back and forth, but you're either going to be at new all-time highs or in the top of this cloud as demand continues to be robust. This is just looking at crude in terms of where we are against the seasonal, but I think it's better to look at the 4-week rolling average. We came back to this 2.6 level. Given where some of the pricing headwinds are going to be prevailing, we were saying we should stick between that 2.7, 2.8. We should probably take that down about 100,000 barrels, just given where the pricing is. And it should be about between that 2.6, 2.7, just given where prices are, where time spreads sit. It'll make it a bit harder to say, look, you should be buying U.S. crude. We had South Korea buy some for March loading. So again, you're still seeing some movements, but given spreads, you're just not going to see Asia buying in any meaningful way. Europe will be there, but they're going into a bit an increase in turnarounds. So that will again put more pressure on U.S. exports. Then when you look at propane, again, right back to the highs as we continue to stay what we think will be right around the 5-year average at this point, just given how pricing sits. Now, when we turn to the physical market, the loading market here, you can see that Libya is back to its to about 1.1 million barrels a day. There's going to be some unknowns on where are the elections. There's some pressure on the current PM not recognizing the new PM. What is going to happen on the transition of power, and then the same thing is what is going to happen to those Russian cargoes. We've seen the Russian cargoes sell at all-time lows in terms of differentials. Things tightened up a little bit, but we're going to talk about that in a minute. Norway, right back to where we were on that 1.56 million. Nigeria, same thing. Angola, a little bit of a decline in Feb. Some of that, again, as we were saying before, got deferred into March, and everything else is moving fairly normal against in terms of where we should be on a seasonal basis. So now when we just look at what we're talking about on Urals, so Trafigura sold Urals to Exxon for March delivery to Northwest Europe on the Platts window at the deepest discount since early July. Surgut offered 3 cargoes of Urals from a Baltic tender. When you look at what it sold for, the crude to Exxon sold at minus $3.40 less dated Brent. That's the lowest price for a deal in the window since July 7th. Urals last changed hands at $3.10 to $3.15 below dated Brent, and now you have some offers out there for about negative $3.60. So again, kind of the back and forth. If you remember, we had everything went no bid. There was nothing out there, even though there was some offers going out to about below $7. But then when the comments happened that Putin was going to pull back, and you're starting to see some of these adjustments, that's when we had some of these sales. Vital reduced its offer price for the 3rd time this month for a cargo of Nigeria's crude. We did have it strengthen just a bit, but that did get sold. And when you look at what is causing this, you're starting to see some of these different shifts in terms of movements in general. And it's as pressure came back into Urals, that's when you had Nigeria. So they were reducing prices. They finally sold their cargoes a little bit higher than their current offer. So again, you're starting to see some of that movement in West Africa. But as West African offer prices in general have fallen by about 50 cents to $1 against dated Brent over the last 7 to 10 days, West Africa differentials are also being hampered by competition from rival grades in the Atlantic Basin and that seasonal maintenance we keep talking about. So, but the Brent Dubai spread is also putting pressure on West African crudes because it prices off of dated Brent. So at that point, would you rather take dated Brent, from West Africa, or Dubai Oman priced crude from the Middle East? And that's where we do expect to see the Middle East clearing a bit more. We also had some ESPO and SOCOL cargoes moving back above $7. And it's really as we have a bit more activity from China, but also that timing. So if you remember where they normally were trading previously between $4.70 and $5.60, Russia, 3 cargoes of Russia ESPO grade traded at between $7 and $7.30 versus the Dubai benchmark. Still cheaper than trying to compete against the dated Brent. And then Surrogate sold March loading shipments at $4.70 to $5.10 in the last spread. And then the SOCOL crude for early April loading was at $7.50 to $7.60. Still about $1 below that peak, but still you're starting to see some of that move, and a lot of that is due to what is going into China, and they're trying to pick up some of these cargoes. Not that I think they would really care if there were sanctions, but again, there's something where trying to get some of this crude in as quickly as possible ahead of sanctions and planning out where some of this is. And just to give you an idea of how little they do care, some of this is for March 31st, April 5th loading. And it's really because this is as they come out of turnarounds and start to get back to normal practices. The Olympics have passed. This has moved through, and we should see some of that additional activity. And they're looking to lock in some of that crude. Now, when you look at the pressure on why you wouldn't take dated Brent and Brent in general, when you look at it versus Dubai, you can see it's now over $6, and it's just again that pressure point that we're seeing on why Middle Eastern crudes will remain in favor versus what's happening in Europe and versus what is happening in the U.S. Now, Occidental Petroleum offered WTI Midland for late March delivery to Northwest Europe. And where it is, they offered 700,000 for March delivery at March dated $2.70. Glencore withdrew an offer for 100,000 tons of Urals at $4.15 less dated Brent, and it's because again they're going no bid, just given what we're seeing and one of the pressures that we're seeing on what's happening with Russia. So again, these are some of the things that we're going to continue to look at, and this is what was going to continue to drive a lot of these time spreads. Now, when you look at crude oil in Europe starting to build, we're coming right in where we were in 2018 and 2020, and we expect this to continue to have us a grind up again as refiners continue to slow down, leaving more of this crude in floating storage. Now, when we look at what happened on the storage front on products, you can see there was a small build in gas oil of 15, a small draw in gasoline of 55, and a sizable drop down in fuel oil of 124. Again, even though with a small build in gas oil, still very bullish spot. The only time it was lower was 2008. So again, you're still seeing a lot of that growth and a lot of that pricing. On the gasoline side, again, you're still at near all-time highs. This should continue to drop as Africa attracts more cargoes. Maybe the U.S. picks up some, but most of it should be directed into the African markets. And then the same can be said for fuel oil, as we're now back, taking out 2021. We're still at near all-time highs, which again is all keeping that ARB open and keeping that flow going from west into east. And we'll talk about why when we look at Fujairah and Singapore. So then when you look at Singapore here, you had a pretty sizable drop of a little over 3 million barrels. So here you had a big drop in light distillate from 15.7 to 14.3, middle distillate from 8.2 to 7.4, and then a drop in resid. So when you look at the seasonal periods, it's fairly normal in terms of what is coming through, nothing too crazy in terms of the location. We do expect this to, again, go back and forth. We have more light distillates coming in, and we should get a little bit of an increase in middle distillate, as we do expect a bigger drop in resid, but some build in light and middle to kind of keep us in this level field. Light distillate, you can see back down to where we were, still seasonally adjusted highs, above where we were, below where we were in 2021, but above 2020. and we expect this to remain in a fairly tight range. Even as we do have more cargoes, a bit more driving, there's still being more cargoes available, and that's going to keep us, at this point. While middle distillate had that drop, still above the lows from 2022, but again, just staying at this very depressed level. And again, that is going to produce a higher price, which is going to pull some of this additional resid out of the system. You can see that we're still elevated versus historics, but we should see some of this additional drawdown over the next few weeks as, again, that competition and pricing pulls more out. Now on the Fujairah side, you can see that we had a sizable drop. Total oil products were reported at 14.266 million, lowest level since reporting began at the start of 2017. And then the total stocks fell 5.667 million. This is the single largest overall fall in stocks since the, again, reporting started. Previous record low was on November 22nd last year when stocks fell for a little over 4 million. So when you look at some of the moves in general, light distillate had a drop of 1.622 million. The East of Suez gasoline market was supported with cracks for the fuel reaching multi-year highs in recent days as strong demand, had some, and then we had some of those draws, which again pulled some of that into the system. We do expect some of that light distillate to come back and start to build, but still be in a better spot. Now, middle distillate still remains strong, fell by 782,000 barrels. And when you look at the gas oil market, continued to find support driven by supply tightness and still steady requirements in the region. But again, that's going to give way to a bit more of the heavy resid demand, just given pricing in general. Suppliers were being discouraged from storing surplus barrels by the backwardation that we've seen, and again, that's going to shift a bit as we move more into the heavy and the high sulfur. Heavy resid fell 3.263 million. This is the single largest fall on a week-on-week basis since the stock reporting. But remember, we had some really sizable builds, and now we just had that big drop down as we did get an increase in shipping traffic, and again more of that movement as people again moved away from middle distillate into the heavy disty side. We also had some decent weather disruptions, which have since eased, which again also increased some of those movements. But we do expect to see some of those increases, and especially as you see the movement from west to east with cargoes going from Europe into some of these competing markets. This gives you an idea of the explosion in the Brent time spread. This is looking at April versus May. And again, a lot of this is driven just based on what is happening with Russia and the rush to get barrels and avoid those Euro cargoes, especially as the tit for tat and these unknown and these satellite pictures say one thing, people and politicians say another, and which one is going to win out, and the pressure that we're seeing in the underlying energy markets. Now, when you just based on what we've seen, crack spreads still remain supportive, especially on the heavy side, on the FCC hydrocracking side. And that's something that we think is going to remain in Singapore. Again, keeping things fairly elevated when you're looking at the product side and keeping some of those oil barrels flowing through. And here's just showing you how we're still at a seasonal high for our cracking margins on the hydrocracking side. But remember, there's also an increase in cost, which is keeping this also elevated because it has to cover the cost of natural gas or LNG, depending on the pricing, which is obviously still expensive. Now, Urals, this is just, obviously it looks good, but it's, again, they're just not running Urals. So that's also making it look better because you have the differentials widening out as they look to find the replacement barrels. And the same can be said in the Mediterranean. Now, on the China Supertanker crude, you can see that we're back to the highs, and that's a lot because of what's coming from East Asia, from Eastern Russia coming down. That's something that we will continue to see remain elevated coming into the region, especially as the refiners plan to start to ramp back up as we get into March. Now, floating storage side, we're right at 2021 levels in Asia. This is going to remain elevated. We don't see this dropping down, just given, as we just showed, the super tankers coming in. There could be some of that timing delay, but again, you're going to see this remain elevated and well above normal. North Sea, a big drop to zero. Again, a lot of that is just because they're buying local. That's why you're seeing time spreads do this. A lot of this is coming off the water and being pulled right on land. West Africa came down a bit. Still, you can see seasonally adjusted high. The price of dated Brent is going to keep this as a pressure point, and you're going to have to see differentials come a bit lower in order to incentivize some of these movements, which is why we're also seeing a bit of a slowdown in selling. It's a bit it's normal for the last 6 months, but it's not normal for the normal average. But again, we're not in normal periods. So Angola still has about 7 cargoes. Last year they had 5. Last month they had 5. Congo still has 1. Last month they had 0. So again, a little bit slower, but still moving forward. And the bigger issue is the Middle East. So you can see that there was a big spike in floating storage in the Middle East. Now, as the spreads have done what they've done, we do expect this to come down. And it's a positive that there was a spare cargoes to kind of absorb into the system and soften some of the blow. But this is going to be the one to watch to see really how tight is the market, because West Africa is going to remain elevated given dated Brent spreads. This is going to give you an idea of how tight is the market, how much is available, because when you look at the spreads between Dubai, Oman, and WTI and Brent, you're going to see this be the preferred cargo just based on prices. Europe, same thing. It's going to stay low as these cargoes are pulled in locally. And then rounding this out, when you look at what is happening in Shandong, the teapots, you had another decline. A lot of this is driven based on obviously the Olympics. They have been asked to not start back up till at least the 20th, and then they have maintenance season, which will start to turn around. But as you can see, that is a very normal thing. Obviously, it's more than normal given the average, but we do expect this to come back and just come right back to the 2017, 2021 range, and then stay fairly stable as we go through the remainder of the quarter, remainder of March, really. So if you have any questions, you can reach us in the comment section. You can find us on Twitter. We're always happy for dialogue and for some back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.